Andrew, I wanted to come back to a point that you had made around correlations, being sort of the resident quant, if you don't mind that stigma. Given the last panel, we know that there's a bright future for it. But I'm wondering how you guys are approaching some of your analysis. Are you know, we talked about this idea of questioning assumptions. Is it that your time frames have changed? Are you looking at things more short term when you're trying to assess potential risks, or are you trying to look at outside variables to help you get a better sense of where you should be allocating capital?
Yeah, I mean, I think very broadly speaking, from a risk management perspective, what we try to do, first of all, is have a better handle on what our exposures are, along a number of different dimensions, where you try to think in very creative ways how, what types of risks you need to know about and be monitoring, and then make sure that we have good systems in place so that we have a better sense of, can monitor that on a more timely basis and provide more information to portfolio managers. And then that then provides some protection against the correlation issue in the sense that you do have more diverse exposures in a factor sense, across different factors as opposed to asset classes and things like that. And so I think that's probably the most effective insurance against that correlation problem.
Yeah. So some of the main themes, right, we talked about in terms of lessons are correlations, liquidity, transparency. One thing we haven't touched on, though, is the actual assumptions of returns. And I'd be curious to know each of your opinions on, do we need to level set with ourselves and potentially with your investors, what the return expectations should be, and how are you thinking about that? And Ray, I'll start with you. Given where you're at.
Thank you. Let's see. You can take the skewer out of me now for that one. Thank you. This question has come up quite a bit in pension plans and large organizations. Is the expected rate of return too high? I mean, I'm going to sidestep that as best I can, but I think at times that question really is a factor of, what are your liability streams and what are the benefits that are being driven into those liability streams? If you ask me candidly, do I think it's something that's going to be changed in the next year or two? Yes, I think it will be changed across the spectrum. I think a lot of organizations are looking at this and they're going to have to deal with it. The hard part is, how does that affect your funding, and how does that affect the sponsor that is feeding you? This isn't an issue that state plans also have. I mean, I was at a corporate plan before this, and it's the same issue you have to deal with. I mean, it's a challenging question. It's a difficult problem, but it's one that's going to have to be worked through carefully.
Yeah, I think a lot of my hedge fund colleagues might not like this, but I think definitely that we probably have to take down where we think returns will be, and they're not going to be what maybe historically they've looked like. That doesn't mean they're not great risk-adjusted returns, but I think it's definitely, we're in a more difficult environment to generate alpha. I think a lot of us, particularly in the equity markets, would agree that it's difficult to deal with the kind of correlations that we're seeing and the amount of fundamental and macro impacts that the markets are having on a general basis. So do I think we'll be able to generate a great Sharpe ratio and a good return, a risk-adjusted return? Yes. Do I think returns are going to look back again like they did in the late 90s and mid 2000s? I think it would be difficult. I think there's a lot more competition out there. Information flow is much more easier to get. But that doesn't mean that I don't think, I think hedge funds have a very interesting place in people's portfolios, and I think people are starting to understand that. Definitely 08, hedge funds got a bad rap, but if you look at a risk-adjusted return of a hedge fund and being on a long-only portfolio, I don't think it was that bad. I think returns will probably be more difficult, but risk-adjusted returns, I think we'll still be able to get very good returns for our investors.
Andrew?
Yeah, I would agree that, for the most part, certainly large institutions need to lower their return expectations, and I think that's due in part to the fact that a lot of those expectations are based on, historical data during kind of the golden age for Western economies. And going forward, I don't think we can necessarily expect to earn the same sorts of returns that we did, in the 50s, 60s, 70s, and so forth on through the end of the century. And certainly some investors can invest in hedge funds, they can invest in developing economies, but if every single institution were to do that, I mean, there's just simply not enough capacity out there. So not everyone can be doing this, and so in aggregate I think these institutions need to lower their return assumptions.
I would also, just one thing, I would also base it on the fact that, when we look at our multi-strat book today, we are really looking much we looked always at liquidity, but today it's a major issue for us at all time. Make sure that we have a very liquid portfolio, and I think that if most hedge funds are doing that today, and I think that the ones that had a mismatch between liquidities will not probably return to that game hopefully anytime soon. And if that's the case, then there's a pocket for those kind of maybe credit investments that are longer term dated and they've got great returns. But for hedge funds to be doing that, maybe that was a mistake that we all had in 08. And so, those are great returns, but are not in the liquidity basket that most traditional hedge funds should be in.
So just to sum up some of these lessons about, again, returns, liquidity, diversification, correlations, if we could put a bookend on it, how are you guys going to, 3 years from now or 2 years from now, put this into context? Or do we think that this is going to be are we in a new paradigm here, a new regime where we have to question these assumptions, or is it just a matter of having better concentration, as you guys alluded to, on risk management practices and understanding where the risk is really being, where you're really making your bets? Is any
Yeah, I mean, I would say the latter. I mean, in the sense that I think the standards have increased. I think the expectations for what investors, institutions, portfolio managers should be doing is much higher now, whether that be around the models that they use, the systems that they use for monitoring, and so whether you want to call that a new paradigm or not, I'm kind of reluctant to use that phrase, but I think certainly standards have gone up.
I think there's I hate to use the word new paradigm. I think definitely what investors are looking for much more are, I think they'd like the fact that a firm has a good business model. And I think that was less of a question asked for pre-crisis than today. And having the right administrator, and having the right back office, and having the right legal, and the right checks and balances. I think those are questions that we get asked a lot more, and I think that might be a new paradigm. That investors really start concentrating on that. I know that we get a lot more questions. Operational due diligences take much longer. It's a good thing. And I think that, going forward, and that wasn't just, it was be it, other crises that we had, whether it be Ponzi schemes or so forth, pushed us into that realm. And I think that's probably a good paradigm that we're looking at now.
No, I would agree. I wouldn't say that's a paradigm shift, but the expectations are there because of what we're dealing with now. And a lot of folks are sometimes disappointed when I explain to them, I'm going to spend a couple days in your office, and that means operations. It's not just the trading strategies. It's literally walking through, meeting your risk folks. It's not really the dog and pony show that happened in 05, 06, 07. And it's because of the risks that are inherent now. And of course, now you've got to deal with, you can get everything right, whether you've checked the administrator, the back office, the auditor, and still have a problem. So it's an insurance plan, but it's not necessarily going to guarantee results. So you've got to be able to look your board in the eye and tell them you've done everything you can and move forward. And unfortunately these days, that's the nature of what we're dealing with.
I'll pose this question in two ways. First to Andrew and Sebastian, and then I'll maybe change it just slightly for your perspective, Ray, which is, do you find that investors, along this idea of understanding the business risk versus investment risk, are demanding more transparency into your process? And if so, how are you responding to that and distinguishing yourself from your competitors in that regard? And then, Ray, you sort of touched on it earlier, but would love to get your thoughts on how if any, of the types of conversations that you're having with your managers have changed as you try to extract a better understanding of their process and be more transparent. So maybe, Andrew, we can start with you.
Yeah, I mean, definitely there are higher demands for transparency, along a number of dimensions. People are looking for more information, detail about the alpha process, sort of how a manager hopes to outperform. They're also interested in understanding the research process that then gives rise to that alpha process. How is it that a manager would expect to, maintain a viable investment strategy going forward? And then there are also a lot of demands around the transparency of the way a team is structured, how people get compensated, what their career paths are like, because people are interested in understanding whether that team is going to be stable, whether people are going to stick around, whether they work well together, whether they can be productive going forward. So people have to be, you have to open up a little bit. You can't obviously tell people everything. But at the same time, these investors have fiduciary responsibilities themselves, and they deserve answers.
Yeah, I think it goes back to what I said about both on the operating side and understanding portfolio construction is something that we have a much deeper people want a much deeper analysis on. I think how the team works together, that's a question that arises a lot more. How does the PM communicate with his colleagues? Is it an open forum? How much time does he spend at looking at other people's models in the team, and how much of the final choice is his own? I think those are questions that people are diving a lot more deeper in. And everything that was said, I think I agree with.
Yeah.
No, I would agree, but I think the sustainability of an operation is critical for us. If you think about how long it takes us to allocate dollars, it's quite a long period of time, and it's a lot of investment on our end and commitment that we have to put forward in front of our board. So let's just say it's 12 to 18 months to get something done. The last thing we want to find out is, the team is fragmented because someone leaves or the PM leaves, or it's not a sustainable model because this person's going to change the organization, or it becomes an issue for us. And it's not something people looked at before. I mean, somebody can send us their trading data, and the question comes about, what are you really going to do with it? How does that really help you? And it isn't the fact that they're going to send us data and we're going to do something with it. I mean, there's a lot of different ways we can encapsulate it and look at it and analyze it. But it almost begs the question, why wouldn't you offer it? If you're going to have a fund that we're going to invest retirement dollars into, what are you hiding? And that inherently becomes a problem when realizing we have to answer that same question to our board. If it's not transparent to an extent, and if it's not something you can explain, and if your team is somewhat disorganized or you've got some challenges, it becomes harder for us to make the case to our boards too. And if it's going to take us 18 to 24 months to put this together, it's not something we want to work toward. It's not sustainable for you or for us, because it's our reputations too, believe it or not.